price level on silver, frankly, or on gold, except to say that the bull market in gold over the last 50 years, the bull markets, there were a couple of them, were 8 and 10-fold moves. Go back to mid 1970s to 1980, went from the mid $30 level to 850. Okay, or from 2000 lows about $265 gold, and you went to 1920 by 2011 over the next 10 years or so. Okay, that's an 8-fold move. Well, we started from a bare low at 1,050. You do the math.
Gold and silver markets are poised for a significant breakout, according to Michael Oliver, founder of Momentum Structural Analysis. Oliver believes the precious metals, especially gold, are ready to surge, diverging from the struggling stock market. While stocks may see a sharp decline in the coming months, gold could benefit as investors seek safer assets amid growing uncertainty in the global economy. Oliver notes that gold has historically performed well during times of market stress. He points out that during past market crashes, such as in 2008 and the early 2000s, gold often rallied while stocks fell. Currently, gold has been consolidating around the 2,500 mark for several months, which Oliver sees as a healthy pause before a potential move higher. He predicts that if gold can break through key momentum levels, it could see a rapid rise in the near future. Silver, too, is in a strong position to outperform, according to Oliver. While silver has lagged behind gold, it remains significantly below its previous highs of $50. Oliver suggests that once silver clears resistance around $30, it could follow gold's lead and experience a sharp upward movement. Industrial demand, particularly for solar panels, could also provide an additional boost to silver prices. In summary, Oliver believes both gold and silver are on the verge of major gains as market dynamics shift. With the Federal Reserve expected to cut interest rates and global uncertainty increasing, he argues that precious metals offer a reliable hedge against potential market downturns. Investors, he suggests, should pay close attention to momentum signals as these metals prepare for a new phase of growth. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
2008, and was somewhat overbought then. And so when the stock market finally did have a crash event in a year off of its high in that 2008-9 bear, gold joined in. It joined in for all of about 4 to 6 weeks. Where they're going the same way. They weren't going the same way before. And then shortly after that event, stock market continued on down through the first quarter of 2009. Gold was back at its highs by early 2009. So they diverged. But there was that brief instance, and everybody remembers that, at least if you're around then. But if you go back through history and look at even crash events, like I happened to catch the crash in 87 before I set up MSA. I didn't catch it a big way, but I caught it to where it smacked me in the face with realization that, hey, we can measure some of these things. Okay. At that point in time, gold went up 9% that was week or two of that crash. Why? I guess nobody told gold was supposed to go down, when the S&P crashed. But no, it went up anyway. And during the 29 to 32 great bear market, there was no gold futures or freely traded gold then, but Homestake Mining, the biggest gold miner in the world then, had a massive bull market during that huge bear market. Okay, so opposite the stock market. So the attempt to link gold to stocks as a fear element. Yeah, pay attention to it. Yes, if gold were excessively overbought at that point in time, when the stock market decides to really have a puke, then maybe gold will participate to some extent to clean itself up some, or not. So don't think it is a rule carved in gold stone that it must follow the stock market. It certainly doesn't. Okay. Anyway, in the 2007 to 2009 bear trend, the stock market down the whole year and a half period, T-bonds and gold went up. From 2000 to 2002 bear market, gold went up, the bonds went up. Okay. So here we are. I think we're topping out the stock market. Yes, we've taken out the 2022 price highs by about 10% or so in some indices. Some haven't even reached it. And if we roll over here, we think there's triggering factors in the S&P 500 and the NASDAQ 100 that will be engaged in the next quarter. If you merely ooze back down about 5% below where you're trading right now, those indices can't sneeze between now. So if September, for example, unfolds as a wobbly month and we ooze back down several percent, you'll be in a position via our momentum metrics to trigger a structure, break a structure of support level that suggests you could open the Bombay door. Now, it doesn't have to be a crash, but it's likely to be a very sharp onset of major decline. And I think that the Federal Reserve and the monetary factors around the world will increase dramatically liquidity, artificially low rates. It's all the things they do, and that will benefit gold. So anyway, but we do see the stock market being in a very vulnerable position to where September better not be a wobbly, non-headline, but just wobbly a bit, pull back 3, 4, 5%, because you'll be in a position then to trigger certain momentum factors that say, gone. You'll go down. Anyway, so that's what we see in the stock market. And a nice level on silver, frankly, or on gold, except to say that the bull market in gold over the last 50 years, the bull markets, there were a couple of them, were 8 and 10-fold moves. Go back to mid-1970s to 1980, went from the mid-$30 level to 850. Okay. Or from 2000 lows of about $265 gold, and you went to 1920 by 2011 over the next 10 years or so. Okay. That's an 8-fold move. Well, we started from a bare low at 1,050. You do the math. Yeah, we're double and a half. Okay. So no comparison in terms of how much multiple gain has gold had so far in this, 9-year-old bull market. So if you use those old metrics and say, well, we can do what we did then, sure you can. The fundamentals are even more dramatic now. Gosh, you can have $8,000 gold. Now, that's not a target. It's just noting past history. And we also note that back in those periods, when you end those bull surges, and by the way, I'd comment on that, maybe have an after comment on this. When you ended those bull surges, that last several quarters of the bull market, you went parabolic. Gold went up hundreds of dollars. Silver went from, like you said, 20 to 50 in a matter of, several months. The same was true in 79 to 80. It's also true in mid 2010 through April 2011 for silver. You went absolutely off the page. Right now, silver's, well below those price highs, $50. Why is silver? Gold's above those comparable highs. Even copper recently traded over $5, taking out its 2011 high and its 2020 high. And yet silver's still, $30, let's say, it's $20 short of its peaks. Do you think it can't get there? And maybe go past it? Well, be reasonable. Maybe silver's just lagged for certain reasons. And once markets like that get shocked into a new reality, they tend to go berserk. And I think that's probably what's going to happen, is that silver's going to vastly outperform gold in the coming months.
In today's news recap, Chinese silver demand surges. Is this a calculated move? Gold demand in China has been strong this year, reflecting a broader movement of the yellow metal from the west to the east. But the Chinese aren't just accumulating gold. They have also been hoarding silver in recent months. The Shanghai Metals Exchange has reported a significant surge in silver volume, with prices consistently higher than Western exchanges. The price premium in China compared to the West has been as high as 10%. This signals an extremely strong demand for silver in China. Chinese silver imports have also surged, hitting a 3-year high of 390 tons last December. In June and July this year, imports broke through the 400-ton level. A year ago, import levels were half that, averaging in the 200-ton range. Last year, China held the second largest silver reserves in the world, trailing only Peru. Chinese reserves were reported at 71,000 tons. Peru, a major silver producer, had a silver stockpile of 98,000 tons. U.S. silver reserves were 23,000 tons, ranking 7th globally. If the Chinese can push the silver price higher, it could have major implications for the West, the Post reported. If the price of silver continues to rise, it could increase production costs for a wide range of industries, from electronics to solar panels. This could lead to higher consumer prices and a further slowdown of economic growth as China outproduces the West in electronics and solar panels. However, there is some indication the growth in Chinese solar panel production could go beyond market-driven demand. According to a recent Bloomberg report, the Chinese are producing solar panels at an excessive clip. There is some speculation that the Chinese are engaging in some low-level economic warfare, hoping to put the squeeze on Western economies. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Go back and look at 2001, in January of 2001, about 4 or 5 months off the high, not far off the price high back then. The Fed cut rates twice that month. Somewhat surprised the market, okay? They cut rates for the next 2 years. It didn't do a bit of good. Stock market collapsed. In fact, when they started cutting rates, if you circled where the S&P was and went short then, it did great, okay? In 2007, 1 month before the high, in fact, about 3 weeks before the traded price high, which occurred in October 2007, the Fed in September 17th, 2007, cut rates by a half a basis point, and it was shocking. Nobody expected it. The comments from Wall Street were, "Oh, Christmas time party, you know, et cetera, et cetera." It was a guy getting a present you didn't expect. All these kind of comments. I went back and I looked through the newspaper archives to see what the Wall Street reaction was. It was total shock. They did not expect it. So the market rallied, priced in the rate cut, rallied for about 3 weeks. That was it. It was all over when we started to collapse. And they cut rates all the way down, and yet the market went down. Okay. And gold went up, so and silver and the T-bonds went up all during that time, except for that October event in 2008. This time, it's fully anticipated. There's no surprise about a rate cut. In fact, they told us, Powell effectively said so about the second week of July when he was testifying, that no, their focus now is, they want to get down to 2% rate, inflation rate, but they thought they were on target. And they were now focused on their other mandate, which is economic disturbances, unemployment, et cetera, et cetera. And he says, I don't want to wait for data points to demonstrate that we've made a mistake by staying too high, too long. Meaning he's not even waiting for the data points, he said. So that's a hell of a statement, okay? And yet the market, they dropped a little bit and then it exploded over the last month or two off the July low. The S&P rallied back to its high, and it's probably when they open tomorrow, I bet they nip out the high that was made prior to that. They're just short of it right now. Just to nip out the high so they have a headline. And of course, the market has already priced in the rate cut that's likely to occur in mid-September. So it's not a surprise this time. So once they cut the rates, if you buy then, you're sort of late, aren't you? They already told you they were. And we're suspecting you're getting the rate cut rally right now. And by the time they cut rates, whether it's 25 or half a point, I suspect it's going to be half, but we'll see. The market will, not know what to do and start to roll over. And that's when you get your real pain, is if we get a wobble in September, it puts us in position to trigger stuff in October. Meanwhile, gold has been congested. It ran up to 2450 back in April. Right now, we're only $60 above there right now, 25.10, okay, the front month contract. So gold hasn't really been hot over the since April, May, June, July, now August, September. Okay, so 6 months, gold's been steady, mostly sideways, and only recently last month got up above the 2,500 mark. So it's not exactly hot and overdone. It's not like it's been going up for vertically for the last 6 months. It's paused. And I think it's ripe now to engage in a more accelerated upside manner. And we've got some trigger levels that we specify in the weekend report to our subscribers that tell us that this arm wrestling pause that we've had ever since the acceleration surge between March and the April-May high. For silver, it was a May high, much higher than it was in April, whereas gold paused after the April high. Silver went on. But they both have congested and gone into a confusing price chart action, which people think, oh my, it's topping out, or they don't know what's going on. We think it's merely cooling off after a very rapid price surge. And they're now cooled off and ripe to go up again. So I think that's the position of those two core markets. It's basically opposite. In fact, in the weekend report, we showed that since you go back to January this year and plot a gold monthly momentum chart and an S&P monthly momentum chart, they pivoted exactly at opposite months. S&P makes a high, gold makes a low. Gold makes a high, S&P makes a low. Exact same months. So they're total opposites right now. But anyway, I think that's what's setting up is that there's a level of, like we got up to 25.45 on the nearby gold recently, last month. You get back up there again, you're going to engage more strongly. Silver is coiled right now between about 29 and 30. Now remember, it made a low in August in the pullback. No, excuse me, in August at 26.50. So we're well off that low. They ran a bunch of sell stops and cleaned it out and then popped back up. You get back over 30 again, which isn't to say anything great because our highs recently have been 32 plus. Okay, but you get back over 30 and silver is going to re-engage out of this congestive confusion. So gold and silver are poised to reignite. Anyway, it's going to be interesting.
What do you think about Michael Oliver's outlook on gold and silver? Are you preparing for a breakout in these metals, or do you see other opportunities in the market? Let us know your thoughts in the comments below. And if you're looking for more insights, check out this video right here. You won't want to miss it. Thanks for watching, and I'll catch you in the next one.